In this video, I will be going over problem 21.6, which is the last post assignment for chapter 21. So the problem starts off by saying Boss Company's standard cost accounting system recorded this information from its December operations. And you could see it gives us about 6 variances, as well as the standard direct materials cost, actual direct labor cost, and actual overhead rate. And the problem wants us to prepare the December 31st journal entries to record the company's costs and variances for the month. So let me go back real quick, but we're going to have 3 journal entries. One for, you can kind of see these are indented here, so for standard direct materials cost down to direct materials price variance, another one for actual direct labor cost down to direct labor rate variance, and then a third one for actual overhead cost down to controllable variance. As a general rule of thumb, if there is an unfavorable variance, that is going to be a debit, and if it's a favorable variance, it's going to be a credit in the journal entry. So let's get started on these. For the first one, we are going to record work in process inventory for $100,000 to account for the standard direct materials cost given to us. Then we are going to have another debit of $3,000 to direct materials quantity variance, which is unfavorable variance. So like I said, that would be a debit. And then on the other hand, for our favorable variance for direct materials price variance of $500, that is going to be a credit. Finally, we are going to balance this journal entry out with a credit to raw materials inventory for $102,500. This number here is a plug, meaning that we can see here these 3 numbers we had from the information. There was $103,000 total on the debit side and only $500 on the credit. So in order for the credits to equal the debits of $103,000, we need that plug of $102,500. For the second journal entry, we are going to record a debit to work in process inventory of $95,800. I will explain how we got to this number in a second. Then we are going to record the direct labor rate variance, which is unfavorable for $1,200 as a debit, and then the direct labor efficiency variance of $7,000 as a credit, as that is a favorable variance. Then we have that factory payroll payable of $90,000, which is to account for the actual direct labor cost in the given information. So as you can see, this 1,200, 7,000, and 90,000 were all given to us, and then this work in process inventory of 95,800 is a plug figure. Again, meaning the credit side here is 97,000, whereas the debit side is only 1,200. So we need this 95,800 so that the debits and credits equal each other. Finally, the last journal entry is going to start with a debit to work in process inventory. Again, this first one is going to be a plug, so let's get the other numbers up here and then I'll explain how I got this number. We are going to record the unfavorable controllable variance of 9,000 as a debit, and then the volume unfavorable variance of 12,000 as a debit as well. And then that factory overhead of $375,000 as a credit is going to go to account for the actual overhead cost incurred. Then, like I said, this 354 is a plug figure, so you can see 375,000 on the debit side, or I'm sorry, credit side, and then 9,000 and 12,000 gives you 21,000 on the debit side. So we need this 354 over here so that when you add all of these up, on the debit side, that gives you 375,000, which is equal to the credit side. If you have any questions on any of these post assignments or anything else, please feel free to reach out via email. That is connorneyhart@gmail.com. Thank you.